Hey everyone, welcome to the next session for the 2020 SOFA Summit. I am proud to introduce our next speaker. His name is Chris Picuro. He is the founder of Integrated CPA Group. Chris, how you doing today?
I am awesome, and thank you very much. I'm slightly bummed we're doing this virtually because, I like my Memphis barbecue, but I'm so excited that you guys are continuing with the event, and I'm honored to even be a small part of it. So thank you very much.
Yeah, of course. We had an absolute blast with you last year in Memphis, but with COVID, we have to do things virtually. So as all of you investors know, one of the big benefits of owning real estate is that you're going to get a lot of tax benefits. But one of the big questions and hurdles are what tax benefits are actually going to affect and benefit you, because the amount of time you spend in real estate, the amount of income you have are all going to change the way and what tax benefits you can actually use. So that's exactly what Chris is going to go over. Chris started Integrated Financial Group back in 2002, which is actually the same time that we started our property management company. So he's got a lot of knowledge, and what's also great about him is he focuses on real estate investors. So this is what he does every single day. So Chris, why don't you share your screen and take it away?
All right, I'm excited here, and so yeah, we have a. Let me just do that real quick. There we go. So as you mentioned, that there are a ton of tax benefits in the real estate business, real estate investing business. I would say one of the top three industries to be tax-wise to be involved with. And one of the common questions that we have is, at what point do some of these benefits become available to someone as a deduction on their tax return? And we're going to walk through some concepts here, and it's very confusing. A lot of people have heard about active participation, passive income, real estate professional designation, material participation, and these are really confusing concepts. So what we decided to do was we love charts, we love workflows within our firm and to share with our clients. Is to come up with an explanation, and we just called it, hey, shooting par on Schedule E. Schedule E is where we report our rental property activity and most of our real estate activity. If you receive a K-1 from a syndication, it's eventually going to get on Schedule E. We have some exceptions with clients reporting real estate activity on Schedule C, but I don't want to get too technical here. But what we want to talk through is, let's assume you have a passive activity loss or a loss from your rental properties. Now, clients get confused when we say loss, because a tax loss does not necessarily mean a negative cash flow. We've developed this concept of tax flow versus cash flow. So we have several clients that have an amazing positive cash flow, and due to tax planning and strategy, pay absolutely no tax on their rental income. Or get it. So that's option one. Option two is that they offset some other income with their losses on tax losses on rental properties. Or option three, those deductions are carried forward into the future, which isn't always a bad situation. So we're going to talk today about, again, shooting par on Schedule E. I'm going to provide you and the group with some flow charts and some tools that I feel are very easy to understand. And we're going to start walking through it. And I'm not a golfer, so, I just came up with par as a passive, active, and real estate professional designation. And whenever in our practice, as you mentioned, about 90-95% of our clients are real estate investors. And when we start getting the same question at least 3 times, we know we need to make a educational resource for that. So I'm going to move forward here, and what you're looking at now is a rental loss flow chart. So as I mentioned in a couple of minutes ago, is that you can have a positive cash flow, but a loss on your tax return from rental properties. People say, well, how can that be? Well, you get to deduct all of your management fees, all of your repairs, maintenance, insurance. Also, you get to deduct your mortgage interest if you have a note on the property. You get to deduct your property taxes, even if you're limited in that $10,000 of real estate and state and local income tax deduction as an itemized deduction or a personal deduction. If it's on a rental property, there's no limit on the amount of real estate taxes you can deduct. That's a question we get all the time. And you also get to deduct the cost of the property. So a lot of people watching this have heard about depreciation. From a technical term as cost recovery system. So if you're investing in residential property, you deduct the acquisition cost of the residential property over 27.5 years. We do not deduct the land portion of the property. So obviously we would like the land allocation to be as small as possible. And I should have mentioned this when you talk about our company. What we do is legally and ethically reduce the amount of taxes you pay in your lifetime. So we have to really look at, what the land allocation is. What do the property taxes say? If you're investing in commercial property, it's 39.5 year depreciation, so cost recovery. So easy example, let's say you bought a $150,000 property. Let's say you have an approximate $20,000, $30,000 worth of land allocation. The remaining amount is deducted over 27.5 years. So every year, you're going to get approximately a $4,000 to $5,000 deduction just on the acquisition of that, because you bought the property, even if you don't have a mortgage. So if your positive cash flows $5,000 on a property, and you have the depreciation deduction of $5,000, you pay no tax on it. So that's pretty cool. So as we walk through this, clients always ask us, man, I have passive income or passive losses to deduct. So investing in rental real estate by default is a passive activity. We're going to walk through that in a couple minutes. So the question is how can I deduct my passive activity losses? And there are 3 ways you can do it. One of them is the first. So we're going to start at the top of the flow chart. Here's your first question. Do you have passive income to offset the losses? So we call it in our industry PIGs, passive income generators. So if you have 3 properties that are creating a net passive income or taxable income, and 1 property that's creating a loss, if you have those 3 properties that are income producing or taxable income producing, I should say, that loss can be offset by that. You don't have to do anything except make an election on your tax return. So at the top, do you have a passive income to offset the loss or qualifying disposition? If it's a yes, then the rental loss is deductible. If it's partially yes and some no, then the yes bucket comes here. You might have passive income from other activities too, such as, we have a lot of clients. Obviously, we have a national focus, but we are based in the Music City. So we have a lot of clients that are musicians, songwriters that receive some passive income from royalties. And depending on their facts and circumstances, that could be a passive income, and then you'd have a passive loss to offset it. So one of the first option, and then we're going to talk through the other 2 exceptions, is the rental loss is deductible if you have passive income. If the answer is no, the next question is, do you actively participate in your real estate activities? Well, you might say, let's move us over here, Mark. All right. What constitutes active participation? It is very easy to have active participation in real estate. You have to just own at least 10% of the rental property. So if you're in a syndication deal where you're only a 5% owner, it's going to be hard to say that you have active participation in that as a standalone item. And number 2, you have to make management decisions. So even if you have an awesome property management firm executing the decisions, the fact is that as long as you are making management decisions, like in most property management agreements have this in place. So the PM is probably going to do your tenant screening and negotiate your rental terms, but ultimately as an owner, you're going to approve those. So as long as you're doing that, which pretty much 99% of the time someone is, then you have active participation. So let's assume you say, no, you do not have active participation. At that point, you are, for tax purposes, for federal tax purposes, you're considered a real estate investor category person. And all your passive activity losses carry forward into the future. They're not gone. And we're going to talk a little bit at the end as far as that might be a good thing. But all of those losses carry forward, and there is no current year deduction for rental losses. one of the things that I really want people to look at is if you're ever changing CPA firms or tax preparation software, if you're a do-it-yourselfer, I've seen passive activity losses missed all the time. And because that eventually is a deduction when you qualify for one of the other exceptions, or if you sell the property. And we never want to lose those deductions. So if you don't have active participation, you're in the default bucket of, you're a passive, real estate's a passive activity, you're a real estate investor category, and you carry forward the losses. If you say yes to this, then you move into the question that we all get hundreds of times a year. And my next question is, do you qualify as a real estate professional? So this designation is a lot harder to obtain. We're going to walk through the real estate professional requirements. Well, again, I'm kind of repeating myself that the real estate investor category is your default designation. Losses offset passive income, which we already talked about, and losses are suspended and carried forward indefinitely. So they kind of work like a capital loss carry forward. So back to the qualified real estate professional. We're going to have to pass a couple tests to be considered a qualified real estate professional. I'm going to show you this next slide first. The first slide is, and we're going to just bounce around a little bit here. The first slide is, do you materially participate in a trade or business which you own more than 5%? So in that syndication deal, let's say you own 10% and you're over 5%. So we jump through this hoop. So right now we're talking about, hey, if I can qualify as a real estate professional, I'm going to be able to deduct all of your income from rental activities is not passive, it's now deductible. Do you spend more than half of your professional time performing services for real property, trades, or business? If you're yes, now the next question is, did you spend more than 750 hours this year performing services for real estate, trade, or business? So these two questions here are the ones that, the top one usually is pretty easy just to say yes. If you're the only owner of a property, then you're there. But gosh, over half of your professional time. So when we run into clients or prospective clients or anyone that we're just advising that has a W-2 job that works, let's say they're a professional, or let's say they work, they own a plumbing company, or they're whatever their job is. It's sometimes hard to have more than half of your professional time dedicated to real estate activities. We see a lot of situations where someone says, yeah, I put in 750 hours in performing real estate trades or business time, but it's not more than half of their professional time. So a lot of times when we're working with a couple where one spouse might be a homemaker, even though that's the hardest job you can have, one spouse works outside of the home, that spouse that works is a homemaker, it's pretty easy for them to pass this test. And as their portfolio grows, they could probably pass that 750-hour test pretty quickly. So the next question is going to be, okay, that's cool, but what counts for those 750 hours? We're going to moonwalk back to the slide before. And the IRS has identified 11 types of real property, trade, or businesses that qualify. We're not going to do list radio, so I won't read them. But in general, it's pretty broad as far as, what qualifies. Not to get too personal, but I'm sure people know that you're heavily involved in real estate and you qualify even though you work in property management and sales and do all this stuff, that qualifies as your 750 hours there. So it's a lot of these things are based on facts and circumstances. There's no form you fill out to attest to this when we prepare a tax return. It's simply, as a CPA, again, legally and ethically reducing the taxes you pay over your lifetime. We have to talk through the situation with you, talk through the pluses and minuses. A lot of times it's a slam dunk, but when we get into that gray area, we're going to want to figure out a way to get you qualified for this. So once we answer that question, are you a qualified real estate professional? We're going down the path of meeting the exception to be able to deduct the passive activity losses. So assuming you say yes, then the next question is, do you have material participation in your rental activities? Well, material participation is actually a little easier to pass this test than the qualified real estate professional. So we've got another flow, we love our flow charts. We have another flow chart for that. Really, material participation, the theory of it is that you're involved in this activity on a continuous and substantial basis. So there's a series of tests IRS has put out that we're going to look at that next in this next slide, and we'll bounce over again. So with material participation, here's the cool thing. You only have to pass one. How many tests do we have? 1, 2, 3, 4, 5, 6 tests. 1 out of 6. That's it. So did you participate more than 500 hours in day-to-day operations this year? So typically you're going to say yes if you're already a real estate professional. But day-to-day activities might be a little different than the bigger picture activities. But even if you say no to that, did you substantially did you do substantially all the work in this activity this year? Did you participate more than 100 hours and more than anyone else? So let's say I put in 400 hours, you put in 100 hours into an activity, I'm still going to qualify as a yes. So it's extremely rare someone's not going to fit into one of these 6 buckets if you're a qualified real estate professional. But you have to have material participation to get into that bucket where we're deducting all of your passive activity losses. And I'm going to acknowledge that, we talk about positive cash flow, like I said in the beginning, and we want people to make money. There's no 100% tax rate. But I'm focusing on your tax flow. And there's some really cool tools we're going to touch on later that if we can get you in this category, then we're going to start implementing different tools than if we can't. A lot of times people come to us and they're trying to put the cart before the horse. They're trying to implement these strategies before we even know if you're going to qualify to enjoy those deductions. So you could see, really again, have you materially participated in activity in any 5 of the last 10 years? So really, it's pretty easy to get this material participation if you're already a real estate professional designation. So I'm going to bounce back here. So if we say yes to do you have material participation in your rental activities? If we say yes, then we hit exception number 2, which I know I'm doing number 2 before number 1. That you're a real estate professional with material participation category. All of your rental losses are going to be deductible. So that's really awesome. And again, we're going to talk in a minute on what tools to accelerate those deductions. If we go back to are you a qualified real estate professional, and we say no, that doesn't mean I can't deduct these losses. It's over. The next question is your modified adjusted gross income $150,000 or more? And if that answer is no, then you are still a real estate investor category. You're still the same category as up here, but because you have active participation and your income is less, you could then deduct up to $25,000 worth of passive losses. And that's another question we get a ton. We always have people come to us with these numbers like, hey, what's up with the 20? I thought I could deduct 25,000, and they know the 750 hours, and they've heard about active participation, and they know little bits and pieces of this, but no one's ever put anything together, to my knowledge, like this, where we put it all together in one flow chart. So let's say, okay, I'm not a qualified real estate professional. My income is $150,000 or less if I'm married filing joint. If you're or head of household, single taxpayer. If you're married filing separately, it's a little different. And if it's $150,000, and there's some phase outs too between $100,000 and $150,000. So if you're $100,000 or less on modified adjusted gross income, or let's just call it your adjusted gross income, you can deduct up to $25,000 worth of rental losses. That does phase out a little bit as we get to 150. So let's assume hey, I got active participation. I'm not a qualified real estate professional. My income, it does exceed 150,000. So if your income exceeds 150, you're not a qualified real estate professional. Then it goes back to this category of real estate investor, and you're back up here. So the bottom line is that in the very beginning I said, if you want to deduct your passive losses, we've got 1. Do you have rental Do you have other passive income to offset it? Or do you meet one of the two exceptions? Exception number one, I am not a qualified real estate professional, but my income is under $150,000, married, joint, or single filer. Or two, I am a real estate professional in material participation, and my income doesn't matter. So you're going to either fall into one of those buckets. Sometimes it's good to fall into a bucket where you're not necessarily deducting all your income. I mean, we're going to talk about that in a minute, and as we get to our last piece. Let's move over again. So with that said, with the flow chart, what we wanted to do is we do a lot of tax planning and strategy. We operate a little differently, where we are a membership-based subscription model. But that being said, we have a lot of tools and a lot of planning opportunities for clients and strategy. And I thought, okay, these are the top things that either people come to us with questions about, or the top things that I think are missed. So I thought, okay, what other tax planning clubs should be in my golf bag, since we are in a shooting par on Schedule E is our theme. So I want to take a few minutes here, since we're doing a virtual event, we're not going to have a Q&A, but I want to definitely run through some of these quote unquote clubs. I will say I have a 2 to 3 minute video on each of these items available for anyone watching this, and I will share that information at the end of the presentation. So the first club would be your rental real estate safe harbor election. So in a situation with tax reform, something was born called the qualified business income deduction. Some people call it, and that was under Section 199A. And what happens is that allows business owners an additional 20% federal deduction based on their net income. And there are a lot of phase outs. I mean, that could be a 4-hour presentation in itself. But the question arose, if I own rental real estate and I have net income on my tax return from the said rental real estate, and I have no other passive losses, am I eligible for that 20% deduction? I've seen it time and time again where it's missed. And the answer is probably. It was a gray area. So whenever there's a gray area, what the IRS does is they usually come out and they say, okay, we're going to provide a safe harbor for you, that if you meet these qualifications, then you're good to go. So let's assume you have net rental income of $60,000. If you meet an extra 20% deduction on that, it's $12,000 deduction. So to meet the rental real estate safe harbor election, in general, you have to have at least 250 hours into your real estate activities. So that's if you have a significant amount of properties, that's pretty easy to hit that one. So if you're watching this and you have net rental income, make sure if you do qualify, if you at least have 250 hours in, and it's not just you, it's you or any of your subcontractors or people you hire. So it's pretty easy to hit this one. And if you have it, you have to make a special election on your tax return that is signed and submitted to the IRS. So for our clients, we have to get a wet signature on something, even though we do everything electronically, and we attach that to your tax return when we send it to the IRS.
I have a question.
Second one. I'm sorry.
Could you utilize the time of your property managers to qualify for the hours? Yes.
So you can. And I've got some videos up that I'm going to share at the end. So it's yourself. I'm looking at my other monitor here, but yourself and anyone else that you hire. So it's a pretty good gig. So yep, it's a pretty good gig. Bear with me. So here it is on the IRS. We'll kind of deviate real quick. Okay, so you have to keep separate books of records. That's pretty easy. For rental real estate enterprises, 250 or more hours as rental services are performed per year. And taxpayer maintains contemporaneous records, but that includes, I know we're doing this on the fly, but that includes people you hire, subcontractors, and that sort of stuff. So it's a pretty easy one to get. So the second one is the de minimis safe harbor election. This is an election you can make that says any expenses in general, any expenses that you incur, even if it's something that you would typically capitalize and write off over time, are immediately deductible under the safe harbor election if they're $2,500 or less. So there's pluses and minuses on this one, because my goal is to try to deduct as much as I can as soon as possible. Usually what we do is if we make a de minimis safe harbor election for a client, we're going to line item it, because we know when it comes to underwriting and financing of the properties, bankability, some people call it, we want to make sure that as many deductions as we can are added back. We know that depreciation is going to get added back. So if we just slap it on your tax return that says repairs and maintenance, then that might not get added back. So we're going to put it as a separate line item. But the nice part about that is, even if you can't take the passive loss, put it on there, because then those expenses are not subject to depreciation recapture down the line, and it makes life easier for you and taxes less in the future. I won't get too technical, but just know that depreciation recapture is taxed at a higher rate than capital gains. So that's why I like that de minimis safe harbor election. Routine maintenance safe harbor election, in the safe harbor for small taxpayers. These are special elections that allow you to immediately deduct on the routine maintenance anything that is maintaining a property, even if it's expensive, as long as you're not creating in general a betterment. And again, I'm going to share with you at the end a more detailed video on all of these bullet points. Safe harbor for small taxpayers. What that means is that as long as your property is $1 million or less in value, you could take the lesser of $10,000 or 2% of any improvements and deduct it immediately. So I'm going to give you an example. Let's say you do new windows, and let's say the property, and it's not the fair market value of the property, it's your basis. So let's say you bought let's say you have a nice $600,000 office building. 600,000 times 2% is $3,000. So actually, let me change it. Let's say you have a $800,000 office building. 800,000 times 2% is $4,000. Let's say you put new windows in that are $3,500. Well, you're above that de minimis safe harbor amount. But under the routine maintenance safe harbor, as long as you're replacing windows that are approximately the same value, the same quality as the windows were previously, or as they were new, then that's an immediate deduction. Now we're going to touch on bonus depreciation in a minute, but with tax reform, some of these two safe harbors aren't as valuable as previously, because we can usually deduct all of these improvements immediately under bonus depreciation. But I want to say, remember, if we can deduct something immediately and not have to capitalize it and worry about depreciation recapture in the future, that makes life easier for us if we dispose of the property. A lot of you already know about 1031 exchanges, a huge opportunity. And my word of caution on 1031 exchanges are going to be, make sure you plan before you do it. Make sure you have a qualified intermediary involved. There are very, very strict rules to enjoy that tax deferral and potentially tax step up in basis if your beneficiaries inherit the properties at some time. So, but 1031 exchanges with tax reform, we're limited. Before, you could actually do a 1031 exchange or a like kind exchange on a vehicle. You trade in your vehicle, you get a new vehicle, you defer the gain. Let's say you had a big truck that you wrote off the whole thing year one. Well, now you can only do it on real estate. This is new with tax reform, qualified opportunity zone fund. We could do an hour on that, but that's a tax planning tool for people that it's a nice alternative to the 1031 exchange, and it's open to people with any type of capital gain. So we really use this a lot when we have people, let's say you're a small business owner and you're selling the stock of your business and you have a big capital gain. Well, you can't do a 1031 exchange on that, but you can do a qualified opportunity zone fund where you're investing you're typically in a real estate syndication and you're deferring the gain, you're enjoying some step up in basis and probably some income. I think one that's going to be really important for people watching here is the 10T election. The 10T election is a technical tax election that says if you use debt secured by your primary residence to buy investment properties, if you want to take that deduction as a deduction against your rental properties instead of a personal deduction, so technically we're moving it from Schedule A to Schedule E, and with tax reform, a lot of people aren't itemizing their deductions anymore. You can do that, but you have to do a 10T election. Mark, we see tons of people from California in the Pacific Northwest that are buying properties in the Mid-South that have tons of home equity. They might have a 3-bed, 2-bath ranch, you know, in Southern California worth $2.5 million. They have no note on it. They want to tap some of that home equity to buy investment properties. They can do that and still deduct that interest if it's done correctly with against that rental property. A lot of people do it with the Burr method, just rolling that money. Cost segregation study is an awesome tool where, again, I'll try to keep it quick, but is a tool that if you are looking for some immediate tax deductions, you are taking the personal property portion of any type of real estate and you're segregating that out and you're getting typically an immediate deduction. You can, especially for any properties purchased in 18, 19, and 20, you can still run a cost seg study for legacy properties, and even if you bought a property in 2015, you could still do a cost segregation study and maybe pick up a huge deduction. The bigger question is, do you need that deduction? Because if you meet one of the 2 exceptions on our flow chart, or have rental passive income, so basically one of the 3 buckets that you can use those losses, then the cost seg study makes a ton of sense. I know, like Mark, you know, in syndication deals, usually a cost segregation study is always done because you're going to have people that are qualified real estate professionals that are already able to take those deductions. So what we do for our clients, that we'll look at the cost segregation study, we'll do a cost benefit analysis, and if it makes sense, we'll bring in an implementation partner to help do that. I touched on bonus depreciation. With tax reform and with the CARES Act, even clarifying any 15-year property, any property that is either for IRS purposes 15 years or less, you could take an immediate deduction for that. So we talked about in the beginning, rental property is a 27.5-year asset if it's residential. If we segregate out the cost, then we could take bonus depreciation on some of that other property. Or let's say you do carpet. The carpeting, you're not going to meet any of these other safe harbor elections. The carpeting costs you $6,000. Well, okay, we have to capitalize it, but we get an immediate deduction for bonus depreciation. And by the way, it's an add back when it comes to bankability. As you can see, every situation is different. So we have to really identify the needs of that investor. There are a ton of benefits for passive loss carry forwards. So let's say you don't fall in that bucket where you can deduct your passive loss. That's not a horrible thing. We are in the lowest tax rate environment I'm probably ever going to see in my career. And maybe those deductions are more valuable in the future, depending on your facts and circumstances. So it's not always a terrible thing to have passive loss carry forwards. What we're trying to do from the beginning, as I said, reduce the taxes you pay ethically and legally over your lifetime. And that doesn't always mean let's take every deduction we can today. The final thing, very, very important for people with multiple property is your rental grouping election. Those tests that we talked about on the flow chart are typically per property. So, and it's very difficult to pass material participation and real estate professional tests on every property, just because, by the way, we don't have like 100,000 hours in a year, right? So you want to make a rental grouping election to group all of your rental activities, all of those properties into one. So, and this is a federal tax election. And on your tax return, if you have multiple properties, make sure your CPA or tax advisor is talking to you about grouping all your properties into one activity. So when the IRS looks at all of these tests that we have to pass, they're looking at your portfolio as it's one big property, not a ton of properties. So I think we're good on I have a couple things I was going to share as far as some additional resources, if you'd like.
Go for it.
All right, so couple things. Our firm made a decision that we're going to create a real estate investor education series public resource. This resource has videos. I'll share the link with Mark and get it out there. You can see there's no views yet because we've been recording these over the last few weeks. So you're actually one of the first people to see this. But all of those quote unquote tax or quote unquote clubs in your tax golf bag have a 2 to 3 minute explanation where I cite where those rules are derived from. In case let's say you're a do-it-yourselfer, or let's say you're working with a CPA that's not really doesn't have a ton of experience in real estate. Again, we really have a passion for education, and you know what good is your knowledge if you don't share it with the world? So these are just little 2 to 3 minute hits on all of the things we talked about. Finally, I would encourage everyone, if you want additional content, we have a professional Facebook page. Please check it out. Oh, we don't need to see me that big, jeepers creepers, but I do weekly posts. I put out a ton of content. I'll share that link with Mark and different videos. I mean, we have tons of stuff talking about PPP, Tax Tip Tuesdays. We do a lot of analysis, such as like, hey, is it better to be an S Corp or an LLC? So I'd love for everyone to like and follow the page and really be a resource for the real estate investor community. So
great job. Incredible.
Yeah, and if you send me a message on the Facebook page, we do reply every day. We'll reply within 1 business day, and again, guide you in the right direction. If our firm's a great fit for you or not, I'm still going to help you out. And anyone that's involved with Mark and their team, we're happy to provide you with a complimentary and confidential initial consultation where I'll share my screen, I'll share my video, we'll walk through your last year's tax return and figure out, 1, where you're at, and 2, if our firm is a good fit to help you accomplish your goals.
Wonderful. Great job, Chris. So I got a question for you. So
Yeah.
since we are in an election year, come early November, are there any of these tax planning clubs or strategies that are potentially on the chopping block? I've heard of a few of them. To where
Right, yes.
maybe now is the time the investors should make a move to prepare?
Absolutely. So with tax reform, we know the tax reform goes through 2026, the way everything is now, and then it sunsets back to the previous rules. A lot of these tax planning tools are in our tax code, so they will be there. Although I have not yet, I will be doing some videos and some analysis of both candidates' tax plans. I have heard that Biden's tax plan was considering getting rid of the 1031 exchange, getting rid of the any type of rental losses, and I haven't looked at the bonus depreciation and cost seg stuff. So it's a little. And the other thing is, if that's the case, we're not sure how long what will happen. I will say, if depending on the election results, if any of these things go away in 2021, then we're going to be hitting the gas pedal on doing a lot of the stuff for 2020's tax year. I don't anticipate that tax reform is reversed, but I mean, anything could happen. I would say the good thing is, just talking through this, I mean, this one, this one, this one, this one, this one, this one, and this one can all be done after the end of the year. So those are elections that you use on your tax return.
Right.
Some of them can be done so like the 1031 exchange can straddle a year. The qualified opportunity zone fund investment could straddle a year. And the cost segregation study just needs to be done before you file your return. So a lot of times with cost seg studies, we're actually looking at someone's tax situation in March and saying, do we want to do a cost segregation study? We don't have to do it by the end of the year. You just have to do it by the time you file your tax return. Sometimes we say, so there's a lot of time. I would say we have about at least a 40% tax extension rate for our clients because one, a lot of our clients have some activities and some documents that we're waiting on. And two, why use all your timeouts in the first quarter, right? We have time. As long as we can calculate what your tax liability is going to be, we have until October usually to file your taxes. Now, we're working through extensions now. I think the optimum time would probably be in the summer to wrap things up because we also have a nice look-see at the next year. So, but there are some strategies we use that have to be done before the end of the year. There are a lot of strategies that go beyond this presentation. And that's what we do when we do tax planning, especially, from August to November is our high tax planning time, is say, okay, what needs to be done? What needs to be done before the end of the year? What can we do after the end of the year?
Yeah, we just went through that exact same tax strategy and planning session for next year, and I need to get more rental properties, need more losses.
Mm-hmm.
A good thing. Well, thank you so much, Chris. That was incredible. It's fascinating how many different facets there are to the IRX tax code, which is why you need a professional such as yourself. So thank you so much, Chris. That's all we had for you guys today for this session, and hope you found some value. Please reach out to him for that free session. It's a lot of value that you're going to get by being associated with this SOFA Summit 2020, and on to the next session.